gold money, there's a story by Alistair MacLeod on the 24th, which was the day of the Brexit vote. And I meant to read this a few days ago, but just didn't get around to it. The collective decision of the British electorate is to reject the recommendation of its government, expecting those of its few dissenting ministers that Britain should remain in Europe. It is a signal failure of governmental policy. Above all, it is the failure that undermines the state's control over ordinary people. Time will tell whether it is just a temporary setback for the world's economic planners or the removal of the keystone supporting the whole structure of the modern statism. There are, therefore, two aspects of the development that must be considered: domestic UK politics and the international economic and political consequences. There can be little doubt that David Cameron and George Osborne, the Chancellor, are now only caretakers, with the duty of managing a planned withdrawal from Europe until their replacement as executive politicians. The withdrawal will be a lengthy process, which over the next 2 years at least will lead to the final official separation. It is possible there will be attempts by the European elite in Frankfurt and Paris to come up with proposals to keep Britain in the EU club and to force a second referendum. Any such attempts will fail because it cannot even be entertained by a caretaker Prime Minister. David Cameron's days as Prime Minister are numbered, and he now has no real authority. The Conservatives will have to elect a new leader, and the bookie's favourite is almost certain to be Boris Johnson. He is likely to be elected by the Conservative Party by the end of this year. Britain's future will therefore be subject to the policies of a Boris-led government, which it has been admitted will have obtained power basically through the failure of the Remain camp to come up with a convincing argument. It was arguably Remain that lost and not Leave that won. While the Leave camp campaigned on an agenda which by implication was for freer markets, it is another thing to assume that regulations and red tape will actually be rescinded. Therefore, a cynic might with justification point out that instead of being controlled by one bench of inept politicians in Brussels, the British economy will be run by another bunch of inept politicians in Westminster. The reality is that Boris Johnson, if he becomes Prime Minister, and his future government are creatures of the system. Importantly, they lack the intellectual basis to confidently challenge it. Doubtless, they will consult the same advisors who supported Remain, not just in the civil service, but in the private sector banks and in big business. No politician, unless he really understands the economic challenge, is immune from the persuasive efforts of the lobbyists and vested interests. Britain's progress, being part of the European superstate to full independence, is therefore unlikely to be smooth. The UK will once again be more exposed to the discipline of private sector markets. Sterling markets are not too big for speculators to attack successfully. There is significant risk, in the short term at least, that Britain will stumble from sterling crisis to sterling crisis. If you think back to that time, I think it was 1998 or 1992, where George Soros basically took down the value of the British pound. And you can see stories on that. We could argue that from today, nothing immediately changes. Britain will still be an EU member for the next 2 years. This is true, but it ignores the fact that markets are forward-looking and will not treat government procrastination kindly. It will be a steep learning curve for Boris and co. Two bits of unfurnished business. There is little doubt that the post-referendum collapse in sterling was accelerated by the derogatory statements of the two men, George Osborne, the Chancellor, and Mark Carney, the Governor of the Bank of England. Both men in office have a duty not to undermine the economy or the currency in their statements. Some latitude can be given in the matter to an incumbent politician, but not to the head of the central bank. If Remain had prevailed, they would have got away with it, but it did not, and the Leave vote carried the day despite their threats. The consequences of their scare tactics, it could be argued, have not only made things worse for sterling and sterling-denominated financial markets than there would have otherwise been, but their statements have contributed to a wider market crisis. Both men are therefore likely to be forced from their office sooner rather than later. Black swans and just desserts. The immediate response in global markets to the leave surprise has been one of panic. Starting with Asian markets and a yen soaring to under 103 to the dollar, gold has just been about the only bright spot, jumping by over 6% to $1,340 at one point. Given sterling's weakness, gold has risen more dramatically, measured in pounds, by nearly 20% to £1,000 per ounce, which now has gone down to about $960. Asian equity markets are taking it badly, with the Japanese market down over 7.5%. This is the overnight market news. With a bit of luck, traders might be more rational when European markets begin trading properly later this morning. However, the global financial and economic situation is dire and ripe for a crisis. At particular risk are the European banks, whose complacent bets on a Remain result will hurt them badly. Expect the share prices of banks such as Deutsche, UniCredit and Credit Suisse to plumb new lows, fueling concerns about their solvency. That is the black swan. Just desserts are the fare of politicians in Europe and the crew of the IMF. The EU is faced with populist demands for democracy, or at least a better system than on offer from the EU hierarchy. It will be lucky to avoid further disintegration, with ex-members seeking their own trade alliances. This is, if a systemic banking crisis doesn't get it first. The IMF also made a very bad and inappropriate call, with Christine Lagarde publicly supporting the Remain mantra of gloom and doom in the event of leave. This important institution, which issues the world's SDR, special drawing rights, would have served markets better if it had kept quiet and prioritised risk control. Its credibility has been badly damaged. I must end this report on one further gloomy note. The bullion banks, in their complacency, have built up large short positions in gold, which by 5 a.m. London time this morning had soared $100 at one point. Unless, during the course of today's trade, gold loses most of this remarkable rise, there could be defaults in this market. The gold market, being based on the one form of money that is no one else's risk, is central to the whole financial system. This could turn out to be the largest worry of all. So then we're going on to Market Watch. Why gold may hit $1,500 by year's end, and it's not just about Brexit. This was on 24th June as well. Implications for currencies. Central banks point to more gold rallies. Gold's impressive Friday rally after a taste of what may be in store for the precious metal, as some analysts say it's just a matter of time before prices top $1,500 or even $1,900 an ounce. Futures prices for the metal soared by as much as $100 an ounce on an intraday basis Friday as the United Kingdom historic vote to leave the European Union sent investors scrambling for a safer place to park their money. But the decision known as Brexit has vast implications for global financial markets, economies and currencies, as well as for monetary policies among the world's major central banks. That means gold could soon have many more reasons to rally. The market's fearful reaction has made Brexit the most stressful event investors have seen since the Lehman Brothers bankruptcy in September 2008, end quote, said David Behem, chief executive of Blanchard & Co. Quote, this is a major negative for global markets, and gold is positioned for long-term price growth because of the Brexit vote and other negative global financial conditions, end quote. While the outcome of the UK's historical referendum rolled stock markets around the world, and European stocks posted their worst daily drop in nearly 8 years on Friday. On Friday, August gold surged $59.3 or 4.7% to settle at $1,322 an ounce, lodging the highest and most active futures settlement since July 2014. Quote, Brexit is a once-in-a-lifetime event, end quote, said Ned, editor of the Value View Gold Report. Quote, all arguments against holding gold have now been crushed, end quote. He expected gold to continue its climb and head to $1,400 an ounce, with prices eventually topping $1,900 this year. And with other EU nations potentially following the UK's lead, the situation in Europe is set to get worse, said Naeem Aslam, chief market analyst of Think Forex. Given that Aslam sees gold, quote, easily touching $1,500 by the end of this year. Currency devaluation. But expectations for more rallies in gold aren't just born from the Brexit news. What happens in other markets, including equities and currencies, will impact gold's outlook more directly. Brexit is, quote, a global monetary event with destructive effects in individual economies, end quote, said Brian London, editor of Gold Newsletter. Quote, but if everyone is trying to depreciate their currency, including the US, what can they depreciate it against? Quote, only gold will stand tall during the turmoil. And over the long term, it won't because it's supposed to be a safe haven, but because it's the only safeguard against fiat currency depreciation, end quote, said London. I'd like to add also silver. On Friday, the British pound dropped 8%, saw its largest ever drop in one day against the US dollar, and fell to its weakest level versus the greenback since 1985. The euro, down 2.3%, also tanked compared with the dollar, while the Japanese yen dropped 3.7%, which is seen as a haven asset, climbed to its strongest level versus the dollar in more than 3.5 years. There is, quote, no reason, end quote, for gold to rise on such an event as a Brexit itself, said London. Such, quote, geopolitical flashpoints, quote, are short-lived. Instead, sustained gains for gold are, quote, based upon currency debasement almost exclusively, end quote, he said. Recession risks and central banks. Following the UK's shocking news, central banks around the world, including the Bank of England and US Federal Reserve, have promised to provide more liquidity in the markets when needed. Quote, this is the biggest risk to markets right now. A possible lack of liquidity like we got during the Lehman crisis, end quote, said Chris Gaffney, president of the Everbank World Markets. The UK vote outcome will, quote, definitely make it very difficult for the Federal Open Market Committee to raise interest rates this year, end quote, he said. In fact, the CME Group 30-day Fed Fund futures are, quote, currently given better chances of a rate cut in the US than a rate hike, end quote. The higher interest rates left the appeal of holding dollars. That also means that a stronger dollar cuts the worth of holding non-yielding gold that's priced in this denomination. Lower interest rates tend to have an opposite effect. Gaffney said there's speculation surrounding a rate cut in the UK, and the European Central Bank could, quote, flirt, end quote, with moving rates even further into negative territory. Quote, lower rates for longer is what we continue to expect. The global economy is going to face lower growth prospects, and rates are therefore going to be kept lower for longer, end quote, he said. Blanchard and Co.'s Beam pointed out that the central banks have, quote, little ammunition left to fight, end quote, a possible economic recession. Quote, they will have to turn to other extraordinary means to keep markets calm and provide necessary liquidity to keep the financial system from stalling, end quote, he said. All in all, that spells out further gains for gold. The metal's $100 trading range on Friday following Brexit wasn't unprecedented, but it was, quote, dramatic, end quote, said Adrian Ash, head of the research at Bullion Vault. He noted that prices made a similar sized one-day move in April 2013 when prices plunged on the back of big declines in gold holdings in exchange-traded funds. And, quote, the uncertainty has only begun, not least about what now happens to the broader European and especially Eurozone projects, end quote, said Ash. Quote, it's all just a taste of the volatility which gold and other markets could see in November, end quote, during the US presidential election, he said. And that's that one. Going on to the Telegraph. The sky has not fallen after Brexit, but we face years of hard labour. Ambrose Evans Pritchard. It's time for Project Grit. We warned over the final weeks of the campaign that a vote to leave the EU would be traumatic, and that is what the country now faces as markets shudder and Westminster is thrown into turmoil. And something you'll notice from these mainstream medias is how dire they portray everything. Turmoil, devastation, disintegration, all these words which are, designed to intimidate and put fear into you of what is potentially going to happen, even though it's inevitable in any scenario. So the stunning upset last night marks a point of rupture for the post-war European order. It will be a Herculean task to extract Britain from the EU after 43 years, enmeshed in a far-reaching legal and constitutional structure. Scotland and Northern Ireland will now be ejected from the EU against their will, a ghastly state of affairs that could all too easily lead to the internal fragmentation of the kingdom unless handled with extreme care. The rating agencies are already pricing in a different British destiny. Standard & Poor's declared the Brexit, quote, spells the end, end quote, of the UK's AAA status. The only question is whether the downgrade is one notch or two. And that hangs on the Holyrood. Moody's has cocked the trigger too. Just how traumatic Brexit will be depends on whether Parliament can rise to the challenge and fashion a credible trade policy, so far glaringly absent, to safeguard access to European markets and ensure the viability of the city, and it depends exactly how Brussels, Berlin, Paris, Rome, Madrid and Warsaw react once the dust settles. Both sides are handling nitroglycerin. What happens now the UK has voted Brexit? Cameron has said he will stand down as Prime Minister by October. The Treasury and the Bank of England have planned to limit the economic turmoil. Laws will now have to be passed to allow the UK to leave the EU. And the 1972 European Communities Act will have been repealed. The PM then will inform the European Council to trigger Article 50. This gives the country 2 years to negotiate its terms of exit. The remaining 27 EU members and the UK will have to reach a deal. During that time, the UK will still abide by EU laws and participate in business. If a deal cannot be reached within 2 years, the UK's EU membership ceases. If there is an agreement, it would have to be put into the Commons. New Acts of Parliament will implement the withdrawal agreement, and EU regulations in the UK will have to be repealed, reintroduced and amended. But given no state has ever withdrawn from the EU, the process is far from guaranteed. Angry reproaches are flying in all directions, but let us not forget that the root cause of this unhappy divorce is the conduct of the EU elites themselves. It is they who have pushed utopian ventures and mismanaged the consequences disastrously. It is they who have laid siege to the historic nation states and who fatally crossed the line of democratic legitimacy with the Lisbon Treaty. This was bound to come to a head, and now it has. The wild moves in stocks, bonds and currencies this morning were unavoidable, given the positioning of the major players in the market and the given that the Treasury, the International Monetary Fund and the Davos Brotherhood have been deliberately, in some cases recklessly, stirring up a mood of generalised fear. But let us separate the noise from what matters. This is not a, quote, Lehman moment, end quote. The sterling route has not been as bad as some feared. You could almost say that we have had a miraculous reprieve, at least for now. The pound has fallen 6% against the euro, slightly below where it was in April. This is a far cry from the warnings of parity. Never credible since the Eurozone itself faces an extensional risk if Brexit is bungled. So that's where I'm going to leave that other story. And on to the final part. Onward towards bullion bank collapse, 25th of June, Saturday. The events of Friday not only speed the eventual collapse of the bullion bank paper derivative pricing scheme, they also highlight the fraud of this current system and shine light upon the utter desperation of these banks to maintain it. We've written an article about countless times over the past 6 years. Here are just 2 recent examples. In short, as a measure of controlling the paper prices of gold and silver, the bullion bank that operates the Comex act as de facto market makers of the paper derivative, Comex futures contract. This gives them the nearly unlimited ability to simply conjure up new contracts from thin air whenever demand for these contracts exceeds available supply, and almost without exception. These banks issue new contracts by taking the short side of the trade versus a spec long buyer. Never do these banks put up actual collateral or physical metal when issuing these paper derivative contracts. Instead, they simply take the risk that their, quote, deep pockets, end quote, will allow them to outlast the spec longs, and without the risk of having to make physical delivery. The banks almost always win. Eventually, an event like the run-up to the Brexit vote or all of the Fed goon jawboning of May will spook the specs into selling by the banks to buy back their ill-gotten naked shorts and lower total open interest back down. If you're not confused by this, please click the second link listed above for more detailed explanation of this process. How this influences price is simple. If the supply of the paper derivative futures contracts was held constant on a daily basis, then the price would have to rise or fall based upon simple supply and demand dynamics. When the amount of buyers exceeds sellers, price would have to rise to a point at which existing owners would be willing to sell. But this is not how the Comex futures market operates, because the market-making banks have the ability to create new contracts from whole cloth. They can instead flood the market with new supply whenever it's necessary. This mutes potential upside moves by imparting fresh, new supply for the specs buying to devour. Price does not have to rise to new natural equilibrium. Instead, price equilibrium is found where demand meets new supply. As a case in point, simply study the market impact on gold prices in the hours that followed the Brexit decision in the UK. As turmoil shook the global markets, gold shot higher and at one point was up nearly $100. However, within hours it had given back nearly half of those gains and then spent the remainder of the day in an unusual and very tight trading range, while virtually every other market was rocked with volatility throughout the trading day. See below. The all-important question of the day is, how and why was this done? Quick look at this chart. So yeah, as we all know, the 100 rise and then just remained in that tight range from 9 a.m. until close. First, the how. At the end of each trading day, the CME Group issues an update that details total open interest changes for both gold and silver. Friday's preliminary totals can be found here. What does the data show? On Friday, with global markets in turmoil and precious metals markets rallying significantly, the bullion banks on the Comex issued brand new supply of nearly 60,000 new paper contracts. At 100 paper gold ounces per contract, this represents a potential future obligation to deliver almost 6 million ounces of gold. Should the spec long buyers ever stand for delivery, which they won't, so ask yourself these questions. Did the world's gold producers all suddenly decide to forward sell and hedge 186 metric tons of future production yesterday, just as the most significant economic event in 8 years was beginning to unfold? Or did the bullion banks suddenly put up a few million ounces of their own gold and then lever it up a few times and issue 60,000 new contracts based upon this collateral deposit? Obviously, the answer to both questions is a big, bold no. Instead, the market making the price manipulating banks simply played their usual game. In a desperate attempt to contain price, they simply issued these 60,000 new contracts and fed them to the spec buyers. So next, ask yourself these vital questions. Without this added supply, which grew total open interest by over 10% in one day, how much further would the paper price of gold have risen yesterday? If a neutral equilibrium was forced to be found between buyers and sellers of existing contracts, would price have settled even higher? 3. How much higher? Gold was up nearly $60 yesterday, but without the paper derivative supply increase of 10%, would it have risen $100 or $200? So now let's address the more important part of the question, why? Simply put, these banks are desperate and on the run. However, in their arrogance, they are still flailing away and attempted to postpone their demise. The minimal amount of physical gold that they do not hold and utilize to backstop the paper derivative market is shrinking rapidly as investors and institutions around the globe seek gold as a safe haven against the financial devastation of negative interest rates. But not only are the banks attempting to reverse this trend that is repeatedly deleveraging their system. They are also desperate to protect their established net short positions from additional paper losses. Recall that the CFTC generates something that it calls the Bank Participation Report every month, and we write about this report every month too. Here's the latest. So let's cut to the chase. With gold at $1,060 back in December 2015, the 24 banks covered by this report were net short just 30,757 Comex gold contracts. After running this net short position all the way to 195,000 contracts on May the 3rd, 2016, the report from June showed a net short position of 133,000 contracts. However, data for this latest report was surveyed on June the 7th, with price at $1,247 and total Comex open interest of 496,000 contracts. By this past Tuesday, in the days before the Brexit total were announced, price had risen to $1,318 and then fallen back to $1,270. However, total Comex open interest had risen 571,500 contracts, and by analysing the latest CFTC generated commitment of traders' reports, we can safely estimate that the banks were likely net short at least 180,000 Comex contracts. Putting this all together, while price rose from $10.60 to $12.70, these 24 banks added about 150,000 contracts of net short liability to their Comex trading operations. So with net position of 180,000 contracts short, and with every contract representing 100 ounces of gold, the paper losses to these banks for every $10 move in gold price amounts to about $180 million. Multiplying that out, when gold was up nearly $100 early Friday, these banks were on the losing side, $1.8 trillion move. Even for the likes of JP Morgan, that's a lot of fiat. So what did they do? Like any arrogant and addicted gambler, they doubled down. They put, quote, good money after bad, end quote, and in doing so, likely increased their net short positions to nearly 250,000 contracts. All of this in order to suppress price and get it back under their control. This also allows them to somewhat control the message gold was sending. Can you imagine the headlines if gold was up $200 yesterday? By holding the gains to just $50, the banks hope to manage the increased physical demand these higher prices are causing and mitigate their paper losses. All of these new shorts lowered price by nearly $50 and nearly cut their one-day paper loss in half. In the end, what's the point of this post? First and foremost, it's simply the latest instalment of our efforts to shine the light of truth upon the incredible fraud and sham that is the current paper derivative pricing scheme. The Comex derived price is not at all related to the price value of true physical gold and silver. Rather, the price discovered on Comex is simply the price of the derivative, with the price of the derivative determined by the changes of supply and demand of the derivative. Barely any physical metal ever exchanges hands on Comex, so it is entirely inaccurate to say that the price discovered there has any connection at all to the underlying physical. So thanks a lot for watching. Please do like, comment and subscribe. I'll see you on the next one.